Welcome to The Explainer. So, let's tackle a really fascinating question in corporate finance. How do you account for paying someone with something that isn't cash? For years, stock options were a huge part of how people got paid, but you couldn't really see them on a company's financial statements. We're going to break down how all of that changed.
Okay, so here's our game plan. First, we'll dig into this weird accounting puzzle that let a massive expense just vanish from the books. Then, we'll talk about the clever rule that came in to fix it. After that, we'll explore the two main ways companies set up these kinds of payments, walk through how the cost gets recognized over time, and finally, we'll really get into why this one rule is so important for seeing what a company is actually worth.
All right, let's kick things off with the central problem. It was this strange accounting anomaly that, for the longest time, felt like a massive loophole. And honestly, it was a real head-scratcher for anyone trying to figure out a company's true costs.
This right here was the core dilemma. Think about it. No actual cash is leaving the company's bank account, but, and this is a big but, it is giving away something incredibly valuable, a piece of its own future, in exchange for someone's hard work. So, should that count as a real business expense?
Well, for a long time, the answer was no. This created what our source material calls an accounting anomaly. It was basically a free lunch on the financial statements. Companies could hand out these valuable options to attract the best talent, but since it didn't show up as a cost, their profits looked way higher than they really were.
And regulators and investors could see this clear as day. The inconsistency was glaring. You've got employees providing real, valuable services, and in return, they're getting real, valuable equity. For that whole economic exchange to be completely invisible on the income statement, it just didn't add up. Right, so a situation like that couldn't last forever. To fix it, regulators brought in a new global standard specifically designed to close this exact loophole.
And that's where IFRS 2 comes into the picture. This standard was built from the ground up to tackle that accounting anomaly head-on. Its mission was pretty simple: make sure these transactions get recorded properly so that the financial statements actually reflect what's happening in reality.
And here is the big fundamental shift. Instead of looking at the cash cost, which, remember, is zero, IFRS 2 makes companies measure the fair value of the equity they're giving away. Now, you can think of fair value as the estimated market price of those shares or options on the very day they're promised. That value, that becomes the expense. It's a huge change from asking how much cash did we spend to asking what's the real value of what we gave up.
Now here's where IFRS 2 gets pretty smart. It recognizes that companies can set these payments up in a couple of different ways, and it gives really clear rules for each one.
So, the two main paths a company can take are equity settled and cash settled. With equity settled, it's pretty straightforward. The company gives employees actual shares or stock options. With cash settled, they pay them in cash, but, and here's the twist, the amount of cash they get is tied to the company's stock price.
And this is the key difference in how they're accounted for. And it's a big one. For equity-settled deals, you figure out the fair value once, on the day the options are granted, and that's it. That number is locked in. But for cash-settled ones, because the company has a real cash liability that goes up and down with its stock price, the value has to be remeasured at every single reporting date until it's paid out. And as you can imagine, that can create a lot more volatility in the company's expenses.
But, wait, a company doesn't just recognize this whole expense on day one. That wouldn't really make sense, right? The employee hasn't earned it all yet. So instead, the cost is spread out over the entire time the employee is working to earn that reward.
This timeline really lays it all out perfectly. It all kicks off on the grant date. That's the day the deal is made. Then, the employee works through what's called the vesting period. And it all culminates on the vesting date, when they officially own the award. That total expense, which was calculated way back on the grant date, gets spread evenly across that whole vesting period.
So let's just quickly nail down these key moments. First up, the grant date. Super simple. This is just day one, when the deal is struck and that all-important fair value gets calculated and locked in.
Then you've got the vesting period. Just think of this as the earning it phase. It's the time the employee has to stick around and work to actually earn those shares or options. Maybe it's 3 or 4 years.
And that brings us to the vesting date. This is the finish line. It's the day the employee has met all the conditions and that award is officially 100% theirs.
So you see, this whole system correctly reflects reality.
The company isn't getting all the benefit from that employee on the first day. It's getting that service over the entire vesting period. And so, the expense for that service gets matched to the exact same period. It's a fundamental accounting principle in action, and it just makes sense. So, after all that, why did regulators go to all this trouble? Why create this whole new standard? Well, the impact it has on financial transparency is, to put it simply, huge.
And this gets right to the heart of why it matters so much, especially for investors. Picture this, you have two identical companies. Company A pays its top engineer a $1 million cash bonus. Company B pays its top engineer $1 million worth of stock options. Now, before IFRS 2, Company A's profit would take $1 million hit, but Company B's profit wouldn't be touched. They had the exact same labor cost, but one looked way more profitable. IFRS 2 comes in and levels that playing field.
When you put it all together, the impact is pretty profound. First, we get a much truer picture of a company's labor costs, which is crucial in industries like tech. This lets investors make real apples-to-apples comparisons between companies. It also shines a bright light on executive pay packages, and it strengthens corporate governance by making sure these costs are out there for everyone to see.
Look, share-based pay is an incredibly powerful tool. It can be the perfect way to align the interests of employees and shareholders, driving everyone to innovate and grow. But it also leaves us with a critical question to think about. When everyone's pay is tied so directly to the daily ups and downs of the stock price, does that really encourage long-term sustainable value? Or does it just push everyone to focus on whatever it takes to boost the stock in the next quarter? That's the essential tension at the very heart of modern pay.